Good afternoon, and welcome to what I think will be a very interesting panel on reprivatizing the American financial sector. Who would have ever thought a couple of years ago that we would have to have a panel on that topic? Beginning in 2008, the United States government began taking unprecedented emergency steps to intervene in the American financial sector. These steps included designating certain financial intermediaries as so-called systemic. These institutions have accepted government capital, subjecting them to additional government process and rules for when and how the government's investments can be repaid. The amount of credit risk within the American economy borne by the federal government and therefore by the taxpayers has increased dramatically over the last year. Accompanying that increased federalization are more regulations governing the extension of credit to individuals, families, and businesses. As the United States begins to recover from the financial crisis, the question is how and when should it reprivatize credit risk as well as liquidate government equity investments in private financial firms? How much autonomy should be exercised by the regulated firms before, during, and after reprivatization? We have four outstanding panelists to present their views today, and we'll have each of them give opening remarks, and then I'll ask any of them who wish to comment on what the others have said and to add anything they like. But we're determined to save a lot of time for you and for your questions. Often in these panels, there's not enough time for questions, so I hope we're disciplined enough to leave you with time for questions that you may have about what these panelists have said. I will introduce each one right before he speaks, otherwise you may forget who they are, and we will. You may forget as well. And we begin with Alex Pollock, who's been a resident fellow at the American Enterprise Institute since 2004, focusing on financial policy issues including housing finance, government-sponsored enterprises, retirement finance, corporate governance, accounting standards, and the banking system. Previously, Mr. Pollock spent 35 years in banking, including 12 years as president and chief executive officer of the Federal Home Loan Bank of Chicago. He's the author of numerous articles on financial systems and the organizer of the Deflating Bubble series of AEI conferences. In 2007, he developed a one-page mortgage form to help borrowers understand their mortgage obligations. He's a director of the Allied Capital Corporation, the Chicago Mercantile Exchange, the Great Lakes Higher Education Corporation, the International Housing Union for Housing Finance, and the chairman of the board of the Great Books Foundation. Welcome, Alex Pollock.
Thanks very much to the Federalist Society for asking me over to share a few thoughts with you today. Thomas Hobbes had this to say in 1651: "By art is created that great Leviathan called a commonwealth or state, in Latin civitas, which is but an artificial man, though of greater stature and strength, in which the sovereignty is the artificial soul, as giving life and motion to the whole body, reward and punishment, by which, fastened to the seat of sovereignty, every joint and member is moved to perform his duty, are the nerves, laws and artificial reason and will, concord, health, sedition, sickness." Hobbes didn't mention the central bank as a kind of artificial heart, creating the circulating blood of money and credit, often to a quite excessive extent. Nor did he mention government-sponsored enterprises and implicit government guarantees, creating in Leviathan obesity and flatulence. And while sedition may be a sickness of Leviathan, financial crisis and panic always moves him to great vigor, activity, and expansion, just as the lengthy financial crisis of 2007 to 2009 has done. As we all know, we've had a great expansion of the role of government in the financial system. How do we move from this expansion toward re-privatization? Or, in this respect, how do we put an enlarged Leviathan on a diet? Let me, in the most summary fashion, touch on four elements of the problem: TARP, Fannie and Freddie, the Federal Reserve's balance sheet, and deposit insurance. First, TARP. Having made equity investments in almost 600 financial companies, is there hope that TARP can withdraw over time? Of course, one aspect of this problem is that the government likes having the expanded control over financial entities that arises from being the TARP investor. Still, I think that with the right approach, there is hope. The closest analogy to TARP is the Reconstruction Finance Corporation, or RFC, of the 1930s. The RFC made investments in over 6,000 banks in those days, or more than 10 times the number of investments that TARP has made. And over time, all of these were retired, most all of them paying in full after paying dividends along the way. The key to making this happen was a businesslike, not political, approach to these investments. The RFC was successfully run by a conservative Texas Democrat named Jesse Jones, who was a tough-minded entrepreneur. Jones wrote, "There was a disposition on the part of President Roosevelt to use the RFC as a sort of grab bag or catch-all for his spending programs." This should sound familiar as it applies to TARP. Jones continued, "But I insisted on its being operated on a business basis with proper accounting methods." This is good advice. A business basis means the point is to manage the TARP investments as fiduciaries for the taxpayers to get their money back. Second, we have, of course, seen the nationalization of Fannie and Freddie, and the equity the government continues to invest in them looks like it will be a dead loss of something like $100 billion or $200 billion. Well, all of us always knew that GSEs and their implicit guarantees, which always were and obviously now are real guarantees, were a bad idea. Fannie and Freddie need to be broken up into three pieces. One, the dead loss or liquidating bad GSE. Two, a truly private business in mortgage finance. And three, a truly governmental entity requiring congressional appropriations for whatever it does, which could be merged into, for example, the Department of Housing, and no GSEs would then be left. Let me turn to the Fed's balance sheet, which is, of course, mostly the balance sheet of the Federal Reserve Bank of New York in particular. The overall balance sheet, as we all know, has grown to over $2 trillion, and it looks, in many ways, remarkably like the balance sheet of a commercial bank as opposed to a central bank. It includes over $700 billion of mortgage-backed securities among its assets, over $140 billion of bonds, debentures issued by Fannie Mae and Freddie Mac. So we have this interesting situation. Fannie Mae and Freddie Mac make mortgages. They sell the MBS and the debt to the Federal Reserve, and the Federal Reserve prints money, of course, but also takes deposits. Deposits of banks at the Federal Reserve are now greater than $1 trillion. This is highly interesting. This is the banking equivalent of putting banknotes in the mattress, a bank holding a deposit at the Fed, more than $1 trillion. The Fed is paying interest on these deposits. So you can have a money in the mattress, risk-free deposit at the Fed, earning interest, rather than lending out these funds in the Fed funds market or employing them to finance lending operations.